you will lose money investing in a leveraged ETF. And it's not because you're a bad investor or you're using a bad strategy or any of that stuff. It's because it's almost built into their functionality. The way a leveraged ETF works and the way math works, it kind of means that if you invest in these things long enough, you will lose money, and they're always kind of working their way towards zero. They're really popular these days. And you can see like TQQQ, which is a three times leveraged ETF on the NASDAQ 100. That's really popular, and people like to sell options on that. They like to sell cash secured puts, and they say they want to do the wheel strategy on it, but you can't do the wheel strategy on TQQQ because it's just going to go down after a certain amount of time. Now, if we compare selling a cash secured put on QQQ and TQQQ, we could sell a 30 delta cash secured put on the Qs expiring January 15th, and we'd make 25% annualized return on that if we sold that today. But we sold the same 30 delta cash secured put, we would make 55% annualized returns. Not to mention that it would take a lot less money to sell the put on TQQQ versus the Qs, but that's neither here nor there. If you're new to the channel, I'm Justin. I like to talk about dividend investing, income from options, financial independence, and I'm putting out videos about 3 times a week. So I'd really appreciate it. If you get anything out of this video, give me a little thumbs up. Subscribe to the channel if you haven't already, all right? So a leveraged ETF, essentially what it is you take your regular boring ETF like your S&P 500, your NASDAQ 100, which would be the Qs or SPY, and they financially rig it up, load it up with leverage or debt or derivatives or however they do it, and then you get 3 times the leverage. So their aim is for every day, if the S&P 500 goes up, $10, a 3 times leverage ETF wants to go up $30. Just multiply that by 3. So a lot of novice investors might think like, if I just hold this for a year or 2 years or something, and the S&P goes up, 20%, this 3 times leverage ETF will go up 60% because it's 3 times leverage. But that's not how the math works, and that's not how the function of these ETFs work. They reset their leverage every day. So if you invest, one day, one day that like your index will go up, say 5%, and your leveraged ETF will go up 15%, but then it resets. So the next day it goes down 5%, your leveraged ETF will go down 15%. And over the long run, the idea that it takes more to make up a gain than a loss, puts this downward pressure on leveraged ETFs. So if you imagine you lose 50% of your money, you don't need a 50% return to get back to even. You need to double your money to get back to even. So it's harder to make your money up from a loss than it is to lose your money. And with that 3 times leverage on an ETF, you always got this big downward pressure on the instrument that's going to push it down for, in the long term. And to show you how this math works on a longer time frame, I made up a couple charts. This first chart is just, you have the blue line, which is your standard index, and then it kind of just goes up some days and down some days. There's no real pattern. This isn't a real chart. I just made this up, kind of throwing numbers into the spreadsheet. And the red line is a 3 times leveraged ETF. Same thing, I just multiplied that by 3. And to see how the 3 times leverage affects the ETF, our blue line, no leverage, it just kind of breaks even after a while. It goes up a little bit and down a little bit and up, and you kind of, at the end of it, it just breaks even. But your leveraged ETF is the red line, and that actually lost money after our time. Starting out with $100 and then going up and down and up and down. Our regular index ended at $100.52. Pretty much breaking even, but our 3 times leverage ETF ended up with $87.18. And even our index had a slight itty bitty profit of 52 cents. Our 3 times leverage ETF was down $13. To make this kind of even more simple, I did up another chart to kind of show it, I think, more accurately, or just specifically show this effect in a chart. And this next chart is, we start with $100, and after the next period, we go up 5%. Next period, down 5%. Up 5%, down 5%. Up, down, up, down, up, down. And then we'll see that we have the blue line, which is our just standard index or whatever. Up 5%, down 5%. Up 5%, down 5%. And after, let's see, how many periods is this? This is 34 periods, 34 days, or however you want to count it. We're down about 6%. We moved from $100 to $95.83 on just our regular index of up and down 5% equally. And it doesn't just wash out. Up 5%, down 5%. We don't end up with 100 because they all cancel each other out. No, we lose a little bit of money after enough time. But when we leverage that by 3 times, we start out with $100 and we end with $67.91. And this graph, you can see it much clearer that we're just always kind of working our way down towards, zero. On the SEC website, they actually have like a warning about leveraged ETFs. And, they say the same kind of thing of how it will reset after every day. But they also have real life examples of returns comparing one ETF to a leveraged ETF. Between December 1st, 2008 and April 30th, 2009, which was a really bad time in the stock market, a particular index gained 2%. However, a leveraged ETF seeking to deliver twice that index daily return, so a 2 times leveraged ETF, fell by 6%. So you would think you'd get, double that, so you get 4% gain, but no, you lose 6% by investing in a 2 times leverage ETF. And an inverse ETF, which just means that instead, when the stock market goes up, the ETF goes down. An inverse ETF seeking to deliver twice the inverse of the index's daily return fell by 25%. During the same period, an ETF seeking to deliver 3 times the daily return of a different index fell 53%, while the underlying index actually gained around 8%. An ETF seeking to deliver 3 times the inverse of the index's daily return declined by 90% over the same period. I'll link this into the description box so you can go ahead and read this leveraged ETF alert yourself. And kind of just, it's a really good example of you just be better off not taking the leverage. You'll make more money, and you wouldn't have this big downside journey because of taking so many losses and leveraging those losses. Moral of the story is, avoid leveraged ETFs and inverse ETFs. They'll eventually reach zero. They're bad news. You're probably going to lose money. You're taking on too much risk. And it is tempting because you do see so much more premium in them, and you think if you just make a few trades, it'll work out. But probably better just to avoid that risk altogether. But I'm not a financial professional. You got to do your own due diligence about all this stuff and do your own research. I'm not your mom. You do whatever you want with your money. I'm telling you that I'm not going to touch it. You probably shouldn't either, but do whatever you want to do. I think that's all I got for this video. Hope you enjoy it. Give me a thumbs up. Subscribe to the channel if you haven't. And I want you to go have a good day, all right? Justin out.